Hello and welcome to CN Professional Institute. In this tutorial, we are going to learn about IAS 19 employee benefit. At the end of this lesson, you should be able to answer the following questions. So these are the learning objectives. So at the end of this lesson, one, you should be able to discuss and apply the accounting treatment of short-term and long-term employee benefits, termination benefits, define contribution, and define benefit work plans. So at the end of the lesson, okay, you should be able to define the following and look at their treatments. We'll look at them, okay, and then we should also be able to define what we call settlement and what curtailment. We also have something we call amendment, plan amendment. So we should be able to define settlement, amendment, curtailment, and account for them. Okay, so we should be able to account for losses and gains on settlements and curtailment, right? And finally, we should be able to account for what asset selling. There's something we call asset selling under IAS 19. So we should be able to what define asset selling and account for it in our books. How do we treat it in the books, right? So these are the learning objectives. At the end or by the end of this video, we should be able to define the following and look at the accounting treatment, right? So let's continue and look at the scope. So every standard has a scope and definition, right? So let's define the topic. The topic is employee benefit. The topic is what? Employee benefits. So what are employee benefits, right? As you may know, as the name implies, employee benefits. So all benefits paid to employees, right? When they work for an employer. Basically, that's what employee benefits are. Okay, so it says employee benefits are all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of what? Employment. Okay, so any benefit paid by an entity to an employee in exchange for services rendered by what? That employee or for the termination of what? Employment is employee benefit. So all benefit due to what? Employees. We have so many employee benefits. Okay, wages and salaries are there. Okay, we have Senate or retirement contributions. We even have profit sharing agreements. We have paid sick leave. We have non-cash benefits like vehicles, fuels, any form of a benefit that is given by the entity to an employee in exchange for the services rendered by the employee as employee benefits. So we have so many examples: wages, salaries, as I said, Senate contributions, annual leaves, basic leaves, non-cash benefits like cars given to the entity, cars given by the entity to the employee. I mean, we have so many forms of employee benefits. So we'll look at it, okay, more in details. And then this is the scope. It says IAS 19 provides guidance on accounting for all forms of employee benefits except for share-based payments. And we are told that this is except for what? Share-based payments. And we are told that share-based payments are dealt with by IFRS what? 2. IFRS 2 share-based payments. So that's it with it. Now, with the scope, okay, you see, under share-based payment, sometimes an employee can work or render service for a company. An employee can work or render service for a company. But instead of the company um, paying the person with money, okay, the entity rather decides to give the person shares, or they give the person the option to purchase shares, or they pay the person based on the fair value of their share price. If that's the issue, then they start saying we shouldn't use IAS 19, even though it's a benefit that's paid by the entity to the employee. They start saying we shouldn't use IAS 19, but we should use IFRS 2 share-based payment. It's a standard on its own, a separate standard, okay, on its own. Those ones, these standards are like corporate reporting or strategic business reporting um, standards. So they are not normally tested in financial reporting. Okay, but they are normally tested in corporate reporting or the strategic business reporting, right? So we'll cover them. So that is the scope, okay, of IAS 19. It applies to all benefits accruing to what? Employees, except share-based payments. And I said that sometimes the employee can receive what? Shares or share options from the entity, okay, when the employee renders service to what? The entity. The employee can receive shares or what? Share options. It says such options or such shares or such treatment, it's covered by share-based payment. You are being paid based on shares. So share-based payment. And it says it is outside the scope. If that's it, don't apply IAS 19, but apply IFRS 2. So that's the scope of IAS 19. Let's look at the objective. So the objective is very, very simple. Okay. So the objective is what? To prescribe. It prescribes when cost of employee benefit should be recognized as liability or what? Expense. And it also prescribes the amount of expense or liability that should be what? Recognized. So the objectives, we have two main objectives. One objective of IS 19 is to prescribe when, okay, the employee benefit should be recognized as expense or what? Liability. So when do you record expense or liability? Right? We'll look at it. So per the accrual concept, we said expenses are recognized when what? Incurred, right? Not necessarily when what? Paid. So we look at that. So the first objective is to prescribe when, I getting it, when do you record employee benefit as expense or liability, and two, what amount do you record as expense or liability. So these are the two main objectives. These are the two main objectives. When do you record employee benefit as expense? When here, and then what amount do you record as the expense or liability? And expenses and liabilities are derived. It says for the liability, if when the employee provides services and the benefit is received in the future, then there's a liability. Okay. And then expense when entity enjoys benefit irrespective of when benefit is received by the employee. So we say liability if the employee, if the employee renders service to you, the entity. Okay, if the employee renders service to an entity, but you are not paying the employee now, you pay the employee in the future. It's a liability. Okay. Other than that, you just have to record, I mean, everything now. Okay. So liability arises when the benefits will be received by the employee in the future. The entity to pay the employee in the future. Right. So these are this objective. One, when do you record employee benefit as liability or expense? And two, what amount do you record? So that's the objective. Let's look at the types of employee benefit. So the standard is all about these four types of employee benefit, especially the first one. So the standard IS 19 provides or identifies four types of what? Employee benefits. Right. The first one is the post-employment benefits, short-term benefits, termination benefits, and other long-term employee benefits. And so these are the four types of employee benefits outlined by IAS 19. Right. We have the post-employment benefits, short-term employee benefits, termination benefits, and then other long-term employee what? Benefits. Now, this is what we'll be looking at throughout the standard. So this is what is covered in the standard post-employment benefits. Here with the post-employment benefits, we have two here. We have defined, okay, we have two. We have defined benefits, and then we have defined contribution. So we have the defined benefit and we have the defined what? Contribution. So we have DB and DC, defined benefits and defined contribution. So this is what we'll be looking at throughout the standard. The short term, the termination, and then other long-term employee benefits. The other three, they are very simple and straightforward. The main thing we'll be looking at here is the post-employment what? Benefit. That's what we're looking at throughout the video, right? But we'll look at the others too, just a brief um, note about them, just like a short note about them and how to treat them. As I said, they are straightforward. There's the post-employment benefit that's a bit complicated, so that's what the standard is about, and that's what we are going to be focusing on, right? So let's look at the other three. Then we'll come and pick the first one, post-employment benefits, the main topic for the video. So let's start with the short-term employee benefits. So as the name implies, short term. When you immediately hear short-term, it's a year or less, right? Less than a year, we said it was short-term. Okay. So with short-term employee benefits, right? It says short-term employee benefits are employee benefits that are expected to be settled wholly within 12 months after the end of the period in which the employee provides the service. So it says they are benefits that are expected to be settled or paid wholly within what? 12 months after the employee has finished what providing what the service. So if the employee provides service to the entity, to the company, okay, if the employee provides service or um it provides service, if the employee provides service to the company, it says with the short term, it has to be settled within what? 12 months. That's all. These are the short term, that's the short term employee benefit. They are supposed to be paid within 12 months, okay, after the end of the period in which the employee has worked for the company or the employee has provided a service for the company or the entity, okay. And these are the short term. As we all know, wages and salaries, right? They are normally paid within a month or monthly wages, salaries, and then the SSC, the Social Security what contributions, right? So before you get your net salary, there are deductions, your Senate contributions. Senate contributions are short-term employee benefits. Then there's something called paid annual leave and paid sick leave. As the name implies, paid annual leave, paid you go on leave, but you are being paid, right? And then we also have what paid sick leave. Okay, so this is they are paid um within a year, 12 months, right? So 12 months or a year. Then we have profit sharing. Yes, there's something called profit sharing and then bonuses. But like so these ones students of professional bodies like ICAG, ACCA, ICANN, CFA, they will look more into it. Like, we have something called the profit sharing and bonuses. Okay. Um yeah, so we have those ones too there. They are also examples of the short-term employee benefits. And then we have what non-monetary benefits. So these benefits are they don't come in the form of money, okay, but they are benefits that an employee receives from an entity or from the company or a company he or she is working with or working for. And then we have what medical care. You can get housing, cars, free or subsidized goods or services. So with the medical care, housing, cars, and stuff, probably taxation, right? When you go to your non-cash allowances, okay, we look at the rent element, the accommodation, the car element, like fuel, those things, where the entity provides car, fuel, driver, those they are all benefits. Okay, that's why in taxation we look at them as benefits in kind. Okay. So they are all benefits and they are all covered under or they are covered by IS 19 employee benefits, right? So these are examples of what short-term employee benefits. Short-term employee what benefits. Let's look at the treatment for short-term employee benefits. So as I said, short-term employee benefits for the treatment, accounting treatment, very, very easy. We said we defined them, okay, as benefit that the entity is expected to settle wholly within 12 months or a year after the end of the period in which the employer has provided what the service. So we said with the short term, they have to be they have to be paid within what 12 months or a year. Okay, within a year after the employer has provided what the service. We look at some examples now. Treatment is very simple. When you pick wages and salaries, what do you do? If your employee has worked for you, has provided service for you, what do you do? So that one is very, very simple. Okay, so it says expense must be accounted for on accrual basis, and any unpaid entitlement should be recognized as short-term liability. So it says we apply the accrual concept. If the employee has worked for you, okay, for let's say the first month, even if you've not paid the employee, you have to set up what, or you have to debit your P&L, wages and salaries. You have to debit expense. I following. So immediately they provide expense for you and you think they are entitled to the benefit, then you have to record expense. So this is very, very simple. With the short term, what do we normally do? We normally debit what? Your P&L. I following. Or you debit wages and what? Salary. So you debit your P&L and you credit your cash, or you credit cash or liability depending on whether you have paid them or what not. Are you following? So it's very, very simple. We debit P&L and we credit cash or what liability depending on whether we have paid them or we are yet to what pay them, right? So if you've not, if you are yet to pay them, then it's saying that we have what we call liability. Okay, short-term liability, current what liability. And it says discounting the liability to present value is not required because it is payable within 12 months. Very soon, we'll start with the post-employment benefit. Specifically, we'll look at the defined benefit and we'll be doing a bit of discounting. We will not do it. Actuaries do that. But you realize that with the post-employment benefit, there's discounting. So we have something called the present value. That's under the defined what benefit, right? Say for short term, we don't discount anything because the payment is normally what we're supposed to be settled within 12 months. So we don't define or we don't discount anything to what present value. Are you following? So that's how we account for the short-term employment what benefit or short-term employee what benefit. You just debit your P&L or you debit wages or what salaries or you debit expenses and you credit cash or what liability, depending on whether it has been paid or not, right? Simple as that. Let's get termination benefits. Termination benefit. So listen to the name termination. So termination benefit happens when the entity, okay, cancels or terminates your appointment. So it's either you the entity, it's either you the individual, you terminate your own appointment. You say I'm not going to work with you again, or the entity terminates what the appointment. Are you following? So it says termination benefits arise when benefits become payable upon employment being what terminated, either by the employer, either by you, the employer, or by what the employee accepting terms to have appointment what terminated. So any benefit paid to an employee, either by the employee terminating the contract, terminating what that contract by him or herself, or by the entity. So the entity can terminate your appointment for various reasons. Or you yourself, you can say, okay, probably I have better jobs to do, or I have to work somewhere, or for so many reasons, you have decided to stop it. Termination benefit. So any benefit paid to you, the employee, as a result of what termination of your the contract, termination of what your appointment. Okay, and I'm saying that can either be done by you yourself. You can say I'm not going to work again, or because of some reasons, the entity themselves can terminate what the appointment. It says one example is what early retirement or redundancy what payment. So with the redundancy payment or early retirement, okay, sometimes employees become what redundant for so many reasons, and they lay some of them, they lay them off. Are you following? So with termination benefits, we said example is what early retirement and the redundancy what payment. So all these ones are what, all these two are examples of what termination benefits that is paid to employees. Okay, and then with the treatment to let me give you an example. Okay, before we get a recognition, let me give you an example. Let's say if a company terminates the appointment, the contract of a worker, okay, and they have to pay, let's say like 3 years salary, 3 years salary to the employee. Okay. How is it treated? So normally what we do is the total payment, the payment for the 3 years, we'll spread it over the 3 year period. So we'll divide it by three and we'll release it small, small into the P&L. So when we divide the total payment, the 3 year payment, we add everything, the 3 year payment, we'll divide it by three, and every year we'll release a portion to P&L, and then we'll have a liability what set up, or we have a liability left, right? So with the termination benefit is very simple. We record two things also. We record liability and what expenses for the termination what benefits. It's very simple. So I'm saying, okay, if you terminate an employee's contract or an employee's appointment and you pay 3 million to the employee for, let's say, a period of 3 years, okay, just divide the 3 million Ghana cedis by what? 3. So you have 1 million every year, and this 1 million every year will be recorded as what? P and will be recorded in P&L as an expense, as termination what? Benefit paid to employees. So every year you record 1 million as an expense, and then the remaining 2 million. So year one, the remaining 2 million will be recorded as a liability. Are you following? Because we said liability arises when there's a present obligation, right? So you divide the 3 million that will be paid over the 3 year period by 3, 1 million. So every year you got 1 million as expense. Then the remaining 2 million for year one, okay, will be recorded as a liability. So this is also straightforward, okay, very, very straightforward. And then we have what we call other long-term or other long-term benefits, other long-term employee what benefits. It says they are employee benefits other than short-term benefits, post-employment, and termination what benefits. So it says employee benefits that are not under the short-term, that are not under the post-employment benefits, that are not under what? The termination benefits. It says these ones should be called or should be put under the heading other long-term benefits. Okay, so they are employee benefits other than the short-term, the post-employment benefits, and the termination benefit. And it says examples: long-term paid absences, such as long service leave, sabbatical leave, jubilee, or other long service benefits. Okay, so we have so many examples. Let me give an example. Example is the long service leave. Okay, um an award also called a loyalty benefit. So maybe if you've worked with the company for a very long time, probably they can give you a leave or what award. Okay, it's also a long-term benefit, but that long-term benefit will not fall under the short-term, or if that long-term benefit is not under the short-term, the post-employment and then the termination, then we put it under what? Long-term benefit. So the long service leave or the award, it's one of the long-term benefits, right? So with the long-term benefits, just note some examples of it and then you are fine. Okay, so we said these are all, they are long-term benefits, but they are not post-employment because they don't happen after you've been employed, or they don't happen after your contract is terminated. Like they don't happen after, but probably they happen during or during the period that you are working with the entity. Okay, so they are long-term benefits, but they are not short-term. Okay, they are not post-employment, and then they are not termination too. It's not paid to you because you are being fired or the contract has been terminated, right? So just know that the other long-term benefits are employment benefits other than the short-term, the post-employment, and the termination. That is other long-term benefits, right? Let's look at the post-employment benefits. So we've looked at the short-term, we've looked at the termination benefits, and then we've looked at the other long-term what benefits. Let's look at the post-employment benefits. Our main topic: post-employment benefits. Post-employment benefits, right? So as the name implies, post-employment, these are benefits that you receive, you are entitled to after you work for the company, and let's say, for example, you've gone on retirement. I following? That's the post-employment benefit. So it says post-employment benefits are employee benefits, okay, other than termination benefits and short-term benefits that are payable after the completion of your employment. So you are done working for them. Example, let's say you are 60 years and you've gone on retirement. Okay, the benefit you receive after completion of your employment, after completion of your service, is what we call the post-employment what benefit. A good example is the retirement pension. Okay, that's one good example. One good example is what? The retirement what um pension, the retirement pension. It's one example because normally you receive your, let me say, you receive your pension when you go on retirement. I following? You receive it after you have completed your service. So that's what we call post-employment benefit. They are benefits that an employee receives after they have completed their service for the organization, after they are done working for the organization, right? That's post-employment benefit. And I gave you one common example that everybody knows or should know is the pension what? Retirement, the retirement pension. Okay, but since the other ones like what? The life insurance and medical care. Right. So this is the most common example of the post-employment what benefit, the retirement pension. The retirement what pension is one of the common examples of post-employment benefit because you receive your pension when you are done, you are 60 plus, and let's say in Ghana here, let's say you are 60 plus, you've um you've completed your service for the entity, you are in retirement, and you start receiving your pension amount, right? So that is the post-employment benefit. The individual or an employee is entitled to these benefits after they are done completing their service for the entity. We have two main post-employment benefits. That's what I've talked about. I said we have the defined contribution plan and we have the defined benefit. So now let's start our main topic, post-employment what benefit. We have two types of post-employment benefit. First one is the defined contribution, and then the second one is the defined benefit plan. So we have the defined benefit plan and the defined contribution what plan. So let's take them one by one and look at them. The defined contribution plans and the defined benefits plan. So let's pick the first type of post-employment benefits, defined contribution plan. Defined contribution what plan. So it says defined contribution plans, okay, it says they are post-employment, they are post what employment benefit plans under which an entity pays fixed contribution into a separate fund, okay, and will have no legal or constructive what will have no legal or constructive obligation to pay further contribution if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current or prior periods. Now, this all we mean, this plenty thing that's here, this what it means. It says with the defined contribution, an entity pays fixed contribution into a separate fund. Let me give an example. You see, in Ghana here, let's say an entity, let me pick any company. Okay, you see, they pay, let's say every month, okay, or at the end of every month, or let's say the year, how they do it. They pay Senate contribution into a separate fund. They pay Senate contribution towards Senate. You see, Senate is a separate fund. So they pay a fixed amount, okay, to Senate. Now, after you are done completing your service, when you go on retirement, do you go to Senate or you go to the entity? Let's say you work with a company. Whilst you were working every year, the company pays your what? Your Senate contribution to Senate. When you go on retirement, who do you go to? Do you go to Senate for Senate to pay you your pension, or you come to the entity for the entity to pay you what? Your pension? Are you following? So with the defined contribution, we say that okay, we pay fixed amount into a separate fund. Let's say Senate. So if you retire, okay, that's the second part. If you retire and the Senate has no enough money to pay you, the entity, the employee, sorry, the employer, the entity, the organization, they have no obligation to further pay any contribution. So all they do is they pay fixed amount to Senate into a separate fund to Senate. Then when you go on retirement or you are done performing your service for them, you are done redeeming your service or you go on retirement, the entity or the organization, they have no obligation to pay anything again. If your money is not enough, go to Senate. So immediately they are done paying you, it's now everything is with Senate now, the separate entity, the separate fund. I following. So when you retire, you don't come back to the entity and ask them for your pension. You don't come and ask them for your monthly pension. You go to Senate, the third party. So it says one, the entity pays fixed contribution is true. Once you are working, they'll be paying your tier one and other stuff. They'll pay it to a separate fund, let's say Senate. Then when you complete your service, you go to Senate. If you go to Senate and Senate has no enough money to pay you, it's not the entity's fault. It's the company that you work for. They don't have any obligation to pay further contribution again. Are you following? So we say with the defined contribution, the risk doesn't lie with with what? The entity, with the employer. It lies with the third party. It lies with what? The entity that's managing your fund for you. Okay, so that's the defined contribution. It says in a defined contribution pension plan, the employer pays an agreed amount of money. That's defined contribution. The employer, your worker, the entity that you are working for, they will pay regular payments at least at regular intervals into a pension fund. I've given an example to be what? Let's say the tier one. The amount of money that the employer contributes is usually a fixed percentage of the employee's wage or what? Salary. Okay. And it is example 5% of the employee's base salary on your behalf. So when the entity is done paying or the company is done paying this amount to Senate and you go on retirement and Senate doesn't have enough money to pay you or the money is not enough for you to pay your for you to like the Senate or the third party has no enough money to pay you, you can't go back to what? The entity. That's it. Well, that's why we're saying the employer has no what? Here. Has no what legal obligation to pay further contribution if the fund does not hold sufficient assets. Okay, so when you pay the amount to when the amount is paid to Senate or a third party, the third party they also invest, right? They invest, they can buy assets and stuff. Senate does that's investment. They invest in other places like GCB. They buy assets, they invest so that when you go or when workers go on retirement, okay, they'll have money, enough money, because there'll be any interest to pay the Senate contribution. Are you following? So it says if the contribution is not enough, it's not the work, or you don't have to blame the employer, the third party or Senate to be held responsible. So when you go on retirement, don't come to the company, go to Senate and Senate will sort you out. That is what we call defined contribution. Are you following? We'll look at the defined benefits. The defined benefits is the opposite of the defined contribution. So we can put them in points. We said point one is that the entity pays a fixed amount here, this point one, into a separate fund. That the company pays fixed amount into what? A separate fund. Okay, so we can just make these ones the basic notes or bullet point. So point one, we are saying that here, point one, the entity pays fixed amount, okay, into here, pays fixed contribution into a separate fund. And we said in Ghana here, we can say they pay to Senate. And two, they have no legal or constructive obligation to pay further contribution if the funds does not hold enough what asset. Okay. So we said that if the amount in the fund is not enough, it is the third party that will be held what responsible. Example, let's say Senate. Okay. So that's all. That is it. So it is not the entity's responsibility to do any top up now. It is the third party's what obligation. So that is defined contribution. Okay. We have accounting for defined contribution. So defined contribution are very simple. We said the entity's only obligation is to pay fixed amount, okay, to a third party or into a fund. And that fund is normally managed by a third party. That is the defined contribution. We said example Senate. So the entity will pay the entity will pay what? An amount, a fixed amount to which is we said normally of the basic salary, okay, to let's say Senate. Are you following? And Senate is now responsible. So when it comes to the entity, the organization, the company, how would they account for it? They set up two main things. They set up only what? Expenses and cash or liability. So expenses and then it is accrual liability. Now look at this, what it means. If the entity is supposed to pay, let's say the Senate contribute, let's say tier one, let's say the 5.5% of the basic salary. Okay. Now, if every year the entity is supposed to pay, let me say, um 5 million, okay, to Senate every year. They have to pay 5 million to Senate on your behalf as an employer. Okay. It says this 5 million should be debited to P&L. So you debit P&L with the 5 million. I following. So it's an expense. So just debit what? P&L with the contribution that they have to do or they have to make to the third party. Example, the Senate. Okay. But let's say at the end of the period, they've not paid all. So we have to credit what? Something. So we credit either cash or liability if they have not finished paying all. So let's say out of the 5 million that they have to pay every month as your Senate contribution or your contribution to the third party to the separate fund, they paid out of the 5 million, they paid only 4 million. So credit cash with what? 4 million. So credit cash of how much? 4 million. So credit cash 4 million. I following. And the remaining for 1 million credit. Okay, and the remaining 1 million credit will go to liability because they've not finished paying. Are you following? Uh-huh. So credit will credit liability with what? 1 million. If they are done paying all the 5 million, then the entry will be will debit P&L 5 million, will credit cash 5 million. They paid all. But if they've not finished paying, then there'll be a liability of what? 1 million. And we're also saying there could also be what we call asset or prepayment. There could also be asset or what? Prepayment. So with the same example, let's say they are supposed to pay um they are supposed to pay the same 5 million. Okay, every year they have to pay 5 million as in it. So we said we'll debit P&L. That's the normal entry. You debit what? P&L with the 5 million. Okay, we debit P&L with what? The 5 million. Let me wipe this and clear somewhere here. Okay, we are saying sometimes there could be asset, not a liability. So you debit your P&L with the 5 million because that's what they're supposed to pay. Or you can debit what? Wages and salaries or any other expense. You debit your Senate contribution or whatever, just an expense with what? The 5 million. But the entity has overpaid. Okay. So let's say for the year they paid like what? 7 million. Are you following? But the actual contribution after they have to pay to Senate or into the fund is 5 million, but they paid 7 million. So can you see there's prepayment? Are you following? So will there be the P&L? But what do we credit? We will credit our cash with how much? 7 million. Because let's say they paid cash. So you credit cash with how much? 7 million. They pay 7 million. And the remaining debit, the difference, you see the difference should be debited because we are crediting more. The remaining debit should be an asset, should be prepayment. So they have to debit prepayment, which is an asset. Pre what? Payment, which is an asset of what? 2 million. So we have an asset because we have overpaid. So prepayment are what? Expenses prepayment are what? Assets, right? So if the normal payment that they're supposed to do for the year is 5 million, but they pay 7 million, credit cash is 7 million, debit P&L with what? The 5 million, and the remaining debit will be asset prepayment of what? 2 million. So sometimes an entity can overpay, okay, amount of money into your Senate, or they can overpay into the third party. They can overpay on your behalf to the third party. The sign say if they have overpaid, there's what? A pre-payment, right? There's a pre-payment, right? So there's an example here. Let's look at it. It's on the defined contribution. Okay. So let's look at it. It's on the defined contribution. Okay. So we'll look at it. We will look at it. Now, let's come here. It says we have it here. Let's solve it and then we look at the defined benefit. Okay. So it says an entity makes contribution into what? To the pension fund for employees at a rate of 5% of gross salary. For convenience, the entity pays what? 10,000 per month into the pension scheme with any balance being paid in the first month of the following accounting year. The wages and salaries for 20XX are 2.7 million. Required. Calculate the pension expense for 20XX and the accrual or prepayment at the end of what? The year. So you see, here it says an entity makes contribution into a pension fund at a rate of what? 5% of gross salary. So you see here the defined contribution. We look at the defined benefits. Here you see the entity is not setting its own fund, but these are they are only doing what? They are only making contribution into a fund. Are you following? So their only obligation is to make payments in the fund. That's all. And I said when the employee when you go in retirement, you don't come to them. You don't have any obligation again. If your money is not enough, you go to Senate, you go to a third party. That's define what? Contribution. Okay, so it says they pay 10,000 per month into the what? The fund. And any amount is recorded as a liability, right? It's paid the following accounting year. Okay, and we've been given the what? The wages and salaries 2 point what? 7 million, right? So how do we account for this? This is very, very simple. This is very, very what? Simple. So look at the total amount that they are supposed to pay. We're told that they are supposed to pay what? 5% of the gross salary. That is their obligation. Are you following? So their obligation is to pay what? 5% of the gross salary. So that's the amount that they record as an expense. Are you following? So their expense is supposed to be 5% of what? The gross salary. So their expense will be 5% of what? The gross salary. And what 5% of the gross salary? That's the amount that's supposed to pay to the third party. Are you following? So they're supposed to pay 5% of the gross salary. So 5% of 2.7 million, which is 2,700,000, right? And what do we get? 5% of 2 million of this, and this will give us 135,000, $135,000. So this is the amount that they are supposed to pay. This is their responsibility, or this amount they have to pay to the third party, the Senate. Okay. Now let's see the amount of payment they made. Let's see payment made. Look at it. It says they pay what? Payment made. We're told that they paid, it says for convenience, they pay what? 10,000 per month into what? Pension fund. Are you following? So for the month, if they pay 10,000 for every month, for the 12 month, how much would they have paid? So that would be what? The 10,000. Are you following? Multiplying 10,000 multiplied by the 12 months. Are you following? What are we going to get? So 10,000 by 12 will give us 120,000, right? So this is the payment they have made for the period. They made payment of what? 120 what thousand. But the actual expense that they are supposed to make is 5% of the base salary, which is 5% of what? The 2,700,000. But they paid only 120,000 because they pay every month. So the total payment for the month is what? 120, right? So if they are supposed to pay 135, but they paid what? 120, then they have a liability. They are not done paying. I following. So they will set up a liability, a current liability. So they will have a liability of how much? You have a liability of a liability liability. So you have a liability of, that's the difference. The 135 that they're supposed to pay, and then the 120 they paid. So you see, they will have a liability of what? 15,000, and this will be recorded as a current liability. Okay, so that's the liability to be having. So if you want to do double entry, it's very simple. We said first of all we debit our expense. Okay, so we debit P and L. Okay, we debit P and what? L, or P or L, with how much? The total amount that's supposed to be 35,000 and 135,000. I following. That's the total amount that's supposed to pay. We are in accrual, so we don't have to wait for them to pay before we record expense. So we debit P and L with it, and then we have paid 120. So credit cash. I following. So credit our cash with how much? 120,000. And then the remaining credit will be a liability because we've not finished paying. So credit what? Liability with the remaining 15,000. So this is a double entry. So here you could say the entity's obligation is to pay only 135 to what? SNET, or to the third party, to the fund. Okay, but they have not finished paying. They paid only out of the 135, they paid only 120. So the 15,000 is the liability, and that's the only thing. And I said again, if at the end of the service, if the employee goes on retirement and there's no enough money in the fund, the entity will not come back to the person will not come back to the entity again. The person will go to the pension fund. The owners of the fund, those that are managing the fund, will go to them. I following. So that's what we call defined contribution. Define contribution. So let's end here. We'll look at part two, where we will look at the define. In part two, we will look at the defined benefits. Okay, that's it. We'll look at the defined benefit plan and look at the difference between the defined benefits and the defined contribution we've done here, and then we'll do more. We'll look at how we account for the defined benefit. We'll do a lot. We'll solve questions, plenty questions. We'll do asset selling tests and stuff, so that you can be prepared for your exams, whether your school exams, your ICH exams, your ACC exams, whichever exams you want to write, right? So I'll see you in part two of IAS 19, employee benefits.